I do think we're going to see higher prices of Bitcoin in 2026. Could be wrong on that, but that's certainly my base case. Because I think we'll see somewhat of a rotation there, somewhat of an exhaustion in the gold market, somewhat of a bid up in the Bitcoin space, especially now that a lot of those treasury vehicle excessive valuations have been, kind of deflated. So that's not really a headwind anymore. Then I think a lot, there still are pockets of equities that are interesting to benefit from the debasement trade. While some stocks are expensive and many markets are kind of at very high levels, I continue to be somewhat bullish on emerging markets on a select basis. Ironically, think banks are not a bad place to be longer term because they've got high rates of cash and treasuries relative to total assets.
Do you think we're going to see higher prices for Bitcoin in 2026? That's the bold prediction making headlines right now, and it's coming from analysts who've been accurately tracking macroeconomic cycles for years. See, we've entered a phase where gold, once seen as the ultimate hedge, is starting to show signs of exhaustion. Investors are slowly rotating from traditional safe havens into digital assets, especially Bitcoin. The excessive valuations of treasury vehicles have already cooled down, and that's removing one of the biggest headwinds for Bitcoin's growth. What we're seeing now is a gradual rebalance, an environment where risk assets like Bitcoin are becoming more attractive as inflation lingers and traditional markets hover near all-time highs. Even as some stock sectors remain overvalued, analysts are spotting potential opportunities in emerging markets and select banking stocks, sectors that could actually benefit from the ongoing debasement of fiat currency.
And so it continues to be an environment that is just challenging for a lot of people, myself included, obviously, but being on the right side of fiscal has been helpful. Basically, if we go back kind of earlier this year, my view was that Doge would be ineffective at any sort of like macro scale cuts. But the tariffs were somewhat of a wild card because, well, I don't think they can stop the train. I don't think they can like permanently and kind of sustainably reduce fiscal spending by a huge amount. They can slow the train, and that's largely because one of the key kind of defenses against reducing the deficit is that Congress is very polarized, and emergency powers to use executive orders to do tariffs is basically a unilateral tax increase that bypasses that polarized state. Now, as you pointed out, the Supreme Court is going to weigh in on that likely in November, last I checked. So far, two levels of courts have kind of ruled against Trump on that. But those, I mean, I'm not a legal expert. The challenge, of course, is that those were, if you look at the makeup of those courts, they were more Democratic leaning courts. Supreme Court's obviously more Republican leaning. But he has put out a number of posts that kind of directly contradict his rationale for emergency use powers. He'll cite domestic issues in Brazil for why they need tariffs, or he'll cite commercial in Canada for why they need tariffs, and that just gives fodder to the other side of that law case. Other than looking at some of the betting markets, I don't have a strong view on how that case is going to go. Of course, before then, you potentially have the ongoing supposed de-escalation in this recent tariff flare-up between the U.S. and China. It's still not fully clear whether that's going to go through or not.
So it continues to be an environment that's challenging for many investors, even the seasoned ones. Fiscal policy has become the key battleground, and being on the right side of it has made all the difference. Earlier this year, the general outlook was that monetary policy alone wouldn't be enough to influence the larger macro picture. The Federal Reserve could adjust rates, sure, but at this stage, fiscal actions, like spending and tariffs, are playing a much bigger role. And that's where things get interesting. The tariffs, while not capable of stopping global trade entirely, have effectively slowed its flow. They're functioning as a kind of temporary brake on the system, a unilateral tax increase that doesn't need to pass through a deeply divided Congress. In other words, tariffs have become a political shortcut for economic control, but that shortcut might not last. The Supreme Court is set to weigh in later this year, possibly November, on whether these executive powers have been overstretched. Two lower courts have already ruled against Trump's use of emergency powers to impose tariffs, but both were in more Democrat-leaning districts. The Supreme Court, on the other hand, has a conservative majority, which adds a new layer of uncertainty. Now, while this plays out, there's another dimension, the geopolitical one. The US-China trade tensions have once again flared up. Though both sides claim to be working toward de-escalation, it's still unclear how far that will go, and markets don't like uncertainty. That's why we're seeing this tug of war between optimism in risk assets like Bitcoin and fear in traditional sectors, because ultimately, what happens with tariffs, spending, and trade policy could define how global liquidity flows, and where investors seek safety next.
If you look at PMIs, you would expect, for example, just looking at them in isolation, if you just say, okay, PMIs are doing this, overall economic activity is slowing to this degree, would stock market be where it is? Would gold have soared as high as it is? Would Bitcoin be 100,000? Would we have kind of had this long of an inverted yield curve without a Ember-defined recession? Basically, the fiscal component is kind of weighing on a lot of that. And I had some discussions or debates with Andy Constant over the past year, and it is true that like we're not accelerating the train right now. If anything, we're mildly decelerating what is still a very fast train, especially in a non-recession environment. These are still very large deficits, and so you have this kind of background stimulatory component that does fluctuate, and that's why I don't just stop writing reports and go to the beach for a year, right? I'm still kind of mapping out the rate of change these things happen, the news events that happens, little booms and busts that happen along the way. So there still are opportunities, there still are uncertainties along the way, but that just kind of underneath this whole sine wave that we normally invest in, there's this higher floor. And so right now, yeah, we're more compressed than we were last year. So basically, we had, of course, the huge COVID stimulus, and we had in 2022 was kind of the contraction from all of that, as well as higher prices. 2023 and 2024 were this kind of reaccelerating period in a more mild sense than, of course, the boom. And 2025 has been this decelerating period.
So, as we look ahead, one thing becomes clear. We're living through a major transition in global finance. Fiscal policy, tariffs, and political shifts are no longer just background noise. They're actively shaping the direction of money, markets, and innovation. Bitcoin continues to stand out as a key beneficiary of that uncertainty. When governments tighten, print, or fight, investors tend to look for assets that exist beyond their reach. That's where the crypto market thrives. In moments when trust in traditional systems starts to fade. Whether you're bullish on Bitcoin, optimistic about Ethereum, or just watching from the sidelines, the message is the same. Stay informed, stay strategic, and don't let short-term volatility blind you to the bigger picture. Because what's happening right now will set the tone for the next phase of global wealth creation. If you found this breakdown helpful and want more updates like this, make sure to hit that subscribe button, turn on notifications, and join us as we track the future of crypto and digital finance together.